Ladies and gentlemen, wonderful good afternoon. It's Wednesday. It's Wednesday afternoon and it's Markus time. I'm really happy to have you here in this webinar, this special day. It's almost the last day, 2020. And of course, it's the last webinar in this Trading Spotlight series here at Admiral Markets in 2020. And by the way, it's a special day. It's my birthday today. So I spend it with you because you're the most important person. And I'm really happy to spend my time with you. Thanks, guys. So today we going to talk about understanding the candlestick charts, including the following topics: the components of a candlestick, of course, then the difference between candlestick and bar charts, and basic patterns in candlesticks, the difference between bearish and bullish engulfing patterns, and what do they have in common. And I'm really happy to talk to you this afternoon with you. Okay, I hope you can make sure that you stay until the end of this webinar, or maybe you watch it later on YouTube if you stay till the end of this YouTube video, because I want to show you why trading is very often dictated by emotions, which can be reading candlestick charts. And we want to switch a little bit to the practical part, to the charts today in this webinar. Maybe you're the first time here in this webinar series, Trading Spotlight, and I'm really, really happy that you spend your time with me. And my name is Markus Gabel. I'm a trader. I'm an analyst, speaker, trading and life coach. And my previous thing I love to do is to coach people and to help them, to make them happy by doing the right things in trading to become successful in trading. I have my own trading service, How Trading, and you can find more on my homepage, tradingandpersonality.com. So by the way, if you want to book their free counseling appointment, please make sure that you get my answering email for the YouTube, for the Zoom link, in the case you want to talk to me. So, and by the way, this is more than 20 years I'm doing this job, and I love to do that because I love trading, because it's a kind of challenge with yourself. And this is the point. And my webinars are always a little bit different from all the others, because my focus is on the human part. And more than that, in this very hard and difficult Corona times, we have to focus on the human part. We're all human beings. And I guess we have to be more friendly to each other. And trading is a really interesting thing to learn more about yourself and your own personality. In this webinar series, Trading Spotlight, is it called, I'm partnering with Admiral Markets, which is a Forex and CFD broker that offers trading over 8,000 different financial instruments through one of the world's best trading platforms, MetaTrader 5, and of course 4. And finally, if you watch this on YouTube, remember to like this video, share with other traders, and subscribe so you will never miss an episode. Maybe you can follow me on Facebook, Twitter, Instagram, wherever you want, and Admiral Markets too. So thanks a lot for your wishes to my birthday. Thanks. I have a little bit chocolate for me today. No cake, just chocolate. I can do it for myself. So, and all the best for you and for your friends. Yeah, unfortunately, we have Corona times here in Germany, and it's not allowed to meet your friends. This is a really bad thing, actually. So it's a really lonely and really calm and quiet birthday this year. And okay, but that's it. It's interesting. As a trader, I learned to accept things I cannot influence. I cannot have an impact on it. I cannot affect it. So it's okay, it's a little bit sad, but whatever. It is like it is. So I will drink a glass of champagne this evening with myself and everything is fine. But it makes me happy to spend my time today with you guys, because, you know, You're the most important person for me because I want to share my knowledge with you and I want to make you happy by show you the truth, how you can make money in trading. And today we want to go a little bit deeper with learning candlestick. Maybe you say, okay, this is boring. Yeah, maybe. But look on the lower side on this slide. You can see it. You can see 81% of retail investors' accounts lose money when trading CFDs. And not only with this provider, you can see the numbers all around the world. So why is it? There's a special reason. Most of traders avoid to learn the basics. And what I want to do is, with my wand, it's a magic stick, we want to open the magic box and we want to go deeper. And maybe you see in my back, there is Master Jedi Yoda. And this is my Mandalorian, of course, because I love Star Trek, by the way. And of course, I love Harry Potter. And I'm absolutely sure you have a wand too. And you can be the chosen one as well. If you are willing to learn the basics and if you are willing to go deeper and if you're willing to change yourself. Vincenzo, we have something in common. I love Star Wars, of course. Okay, and therefore, um, let's make a step beyond the official scenes. I believe in karmic management, and karmic means everything is explainable by the rules of cause and reaction. The point is, if you watch the chart, you look at the obvious things, you look at the reaction. But to understand trading and to make it successful on a long run, you have to learn to look at the cause. And the topic today, the candlestick, is one of the causes. Only if you understand this point, then you can have a clearer look at the point, at the right side of the chart. Because most of the people lose money in trading because they only believe the so-called deceptive truth. So the right side of the chart is just a deceptive truth. It's not the ultimate truth. If it were the ultimate truth, then everybody would trade the same. Then we wouldn't have a trade. Of course not, because you need buyers and sellers. Let's jump in. First slide for this afternoon. Let's talk about the components. And by the way, guys, the chat is open. If you have a question, then let me know. We can talk about everything. We have a little bit of time today because I don't have so many slides. So if you have any questions, please let me know. Let's talk about trading. Let's go 100 years back. Candlesticks charts originated in Japan over 100 years ago. In the 1500th century, but 100 years before in West, it was developed in Japan, and by the bar and point and figure charts. In the 1700s, a Japanese man named Mr. Homer discovered that while there was a link between price and the supply and demand of rice, the markets were strongly influenced by the emotions of traders. Okay, let's think about a little bit about this special point. We talk about the emotions of traders. Now, maybe you can close your eyes a little bit and let your mind wandering far, far away in the past. Now imagine in your minds there's a really big market and there are rice traders. There are the farmers And now think about it. Maybe you had your shop there, and maybe you are a rice farmer there. Long time ago. Maybe you close your eyes and make this picture in your mind. There's a big rice market, and maybe you are the farmer. And now you're sitting or you stand in front of your shop, and the rice bags were in front of you in a one row. And now you think, okay, guys, I was so many hours I stood in the water to get my rice there. I spent so much time for that. And I need that money for my bag of rice. This is what you think. Because, guys, trading is human. Trading is always a kind of human part. And this rice farmer was standing there. He has cold and maybe sick feet from standing hours and hours and days in the rice, in the water to earn this rice. And now he's standing in front of the shop and said, okay, guys, if you want to buy my rice, I need this money. Emotions. And now close your eyes again. You see the farmer. And now think there come another guy with his family into the market. And maybe this is a butcher or baker or something else. He needs rice. And maybe this guy with his family come in to the market. And maybe this guy was thinking, oh, I had a bad week. I had a bad month. I cannot give out too much money for rice right now. And now you see two parts. The farmer said, I need this price. And the butcher maybe, or another whatever business guy said, okay, I cannot give out too much. So now we have these two limit parts in trading at this early or this first market ever. It was the rice market in 1700 or 1500, I guess. So you see, there are emotions in the early stage of trading. The first why we talk about trading means there were emotions on both sides, sellers and buyers. I need this, I cannot give out too much. So, and Mr. Homer discovered and make it visible by candles on a picture or maybe on a plate on the wall. In this picture you should have in your mind. Well, this was the beginning of trading at all. And candlesticks show that emotion by visually representing the size of price moves with different colors. Maybe black and green or green and red, whatever. You can do whatever you want in your chart, by the way. So traders today use these candlesticks to make trading decisions based on regularly occurring patterns that help forecast the short-term direction of the price. Think it through. Think it through right now. What you see in the chart is not the ultimate truth. It's just what traders around the world feel. It can never be the ultimate truth. It can never be completely right or false or wrong what you do on the right chart. It's your perception. You are one single trader among millions and millions of traders around the world. And we're talking about human beings. And every human being has its own emotions. You cannot know what I have for emotions when I start a trade. And I cannot know what you have for emotions if you want to trade, if you want to buy or sell. So you see, we are focused. We are focused on visual things, And this can never be ultimative. It's always a deceptive truth. Without different opinions, there would be no market. Exactly. So therefore, first of all, guys, the market doesn't know you. You cannot know what all people around the world feel if they trade. So why should your trading be influenced by emotions? Why? There is never a so-called, oh, I'm right or I'm wrong, or this is right or this is wrong. Never, 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 guys. So our job as private traders is to follow rules based on special strategies. And if you learn that, you should take a private teacher, by the way. So now let's go a step deeper. And you see on the left side, you see different components. Just like a bar chart, a daily candlestick shows the markets open. So where is my... Where is my... Here we go. So you see open price, left side. So then you see the closing price. Then we have a low price and we have a high price. This is a candle. And you see on the low price, people were more willing to sell. And on the high price, people were more willing to buy. And in this special or in this specific time, this was open and this was the close. That's the point. So the candlestick has a wide part, which is called the real body. So what is the real body? Real body is this. This is the real body. This is the real body, so-called body. And this real body represents the price range between the open and the close of that trading day. And when the real body is filled in black, it means the close in this specific time was lower than the open. This is the left candle here in this slide. And if the real body is empty, or maybe you give it the candle green or whatever you do there, then it means the close was higher than the open. And trades can also, these colors in their trading platform, give it whatever you want. And for example, a down candle is often shadowed at red instead of black, and the up candles are often shadowed green instead of white. So now, this is the obvious thing. This is the obvious thing. Let's go deeper, one step deeper. Let's take the wand, open the big secret box, and then let's go deeper. What does it mean if we have a higher close than the open? Maybe you have a white candle or a green candle. What does it mean? Let's go in. I will show you. You see on the right side, this is the so-called book map. That's the order book. And I often told you the truth. This is the ultimate truth. So now I have a question to you. Can you see in this order book a candle? Type in the chat box, yes or no. Can you see in this order book a candle, whatever, black or red or no black? Can you see a candle? Let me know, yes or no. Okay, I got a no and a no and a no and a no. Okay, we have a little bit more attendees this afternoon. Okay, what do you see? Can you see in the order book a candle? Yes or no? Okay, I got a lot of no's. Yeah, you're right. No. And now the next question. Why do you believe a candle? If you cannot see it in the book map. Is level 3 book access possible for the common guy? Not really, no. Yeah, it is, but it costs a lot of money. Level 3 is most seen by the exchange by itself. But you don't need it, of course not. So you see, the human being is important, guys. The human being is thinking in pictures all the time. If you see in the bookmap numbers, it's completely neutral. In the middle row or in the middle column, you see the price. Left buyers, right sellers, but you only see numbers. Numbers are completely neutral. What do you want to see there? There is no support, no resist. There is no candle you can see there in the bookmap. So therefore, what happens in the bookmap, maybe in one day or 1 hour, is visible by a candle. But this is only what happens during this specific time you watch in your chart in the bookmap. The candle is just what happens in the bookmap. But the order book or the bookmap, to show another word for it, in the order book, you will always find numbers. But we cannot trade by numbers. It's not possible. We need pictures in your mind. So it's like the same example. If you cannot thinking not, you cannot think no. It's not possible. Because that your mind will avoid something, or if you want to think to something, no, I don't want it, you need to have the picture. That's the best, really famous example. If I say, yeah, exactly, do not think about the pink elephant. That's the example. That's a famous example. So what do you have in your mind? I'm really sure you have a pink elephant in your mind. To force your mind to avoid something, to force your mind to say no, you have to know the picture before in your mind. So, which means we have the data from the order book made visible in a candle. But this is the problem. We focused on the pictures. And this is the big failure. You have to think always what happens in the bookmap. And by the way, pictures force us most of the times to emotions. If we are long and we see a green candle, we feel good. And if we are long and we see a red candle, you feel, how do you feel? Most of the time it's a little bit bad. But in the bookmap, they're just only numbers. Only numbers, no emotions there. This is why what I'm talking about when I say, please step behind the scenes. This is the most important part. Okay, but basically, if you see a candle, don't watch it and don't focus on that one candle. Always think everything starts and ends in the order book, just only with numbers. Okay, so above and below a so-called real body, we call them shadows or wicks in this, whatever you say. And the shadows show the high and the low prices of that day's trading. Maybe if you watch a hourly chart, hourly candle or daily chart, then it's the high or the low of that day. And then the upper shadow on a down candle is short. It indicates that the open that day was near the high of the day. And the short upper shadow on an up day dictates that the close was near the high. So the relationship between the day's open, high, low, and close determines the look of the daily candlestick. So real bodies can be long or short, black or white. Shadows can be long or short. So let's switch to the real chart again. So now let's take a daily chart, for example. So you see here on, let's do it a little bit in that way. It's a little bit easy. So you see this one. So this is, in my chart, black means we go up. Red means we go down. So now you can see the following part. So there we had the opening exactly there. This was the close. There was the close. That was the high. And this was the low. And now we can see, think about the book map again, guys. This candle tells us a story. It tells us an interesting story. So what kind of story? And story is really interesting. We opened here. And then the price went a little bit down, which means the smart money forced the unexperienced money to sell that the smart money can buy. Because if you want to buy, here comes the question again. If you want to buy, what do you need on the other side? Let me know. If you want to buy something, what do you need on the other side of the order book? What do you need? It's important. You need, of course, if you want to buy, you need a seller exactly on the other side. So what do? Okay, you trick the unexperienced money out that you can buy. So you send them to short because you know, oh, I need to buy. But if I can buy, I need sellers. So what do? Here you trick them out. It's a fake. They open the market, they send them to short, then they try to sell. But if you, and here comes again, if you want to sell, what do you need on the other side? Type in the chat box. What do you need on it? If you want to sell, what do you need on the other side of the order book? Of course, I love you guys. You're really with me today. Yeah, you need a buyer. So what do? If you have in your mind, and now you're the smart money, and you want to buy cheap and sell expensive, and you have huge amounts, and you want to bring huge positions into the market, and you need to buy, what do? You send the unexperienced money in the wrong direction, because the unexperienced traders are always driven by emotions. They see a black candle maybe in 5 minutes or an hourly chart, they see, oh my God, I have to sell, I have to sell, I have to sell right now. So what happens? If you want to sell, yeah, you need buyers, of course. And suddenly the buyers come into the market with high positions, which means that the volume on the buyer side is suddenly rise, and the sellers are very weak, which means the price goes up and up and up. And if you were short, you have your stop loss anywhere. And if a stop loss is executed, it's going to be to a buy order as well. This pushes the price up, and the price goes up and up and up. So, but the story is not over right now. So you see, the price goes up and up and up. And here was the high. What happens there? What happens there? It's a story, guys. The same guys, they were wrong on the lower side in the first hour maybe of this day. They see during the whole day, oh my gosh, it goes up. So now they wait. First of all, they get stopped out. And a stop order is moved or is changed to a buy order if you were short. So now the price goes up and up and up and up. And now the guys, they bought on the lower side, they come into the profit more and more. And now, next questions. Think it through. If you are one of the buyers and you are really huge in profit and you have a buy order, what you have to do now? Type in the chat box. Imagine you are one of the big players and you have a big profit position in the market long. You are a buyer and you want to go out. What you have to do right now? What you have to do? Type in the chat box. That's not easy. If you are a buyer, and yeah, but what you have to do, fix the profit. That's the other things, guys. Open the magic box. Open the magic box. Think in the book map. You are the holder of a long buy position. And now you went into on the lower side and now the price is rising up. What you have to do? Close the position. That means to sell. Next question. What do you need if you want to sell? What do you need if you want to sell? Yeah, exactly. You need buyers again. So what you have to do, you trick the unexperienced money again. It's again a fake. And on the way up, if you are in profit, you exactly know that unexperienced traders are always either too early in the market or too late. And now the unexperienced money goes long and now they want to buy. And if you want to buy, you need a seller on the other side. And you are big in profit and you need to sell and you find a buyer on the other side. And this is the play, the game between the unexperienced and the experienced traders. Dump money and smart money, which means at a specific time, most of the times here, all the traders come into the market, they want to buy, and you were in profit, and now you come and you sell, but you are the big trader, which means your positions are too big, which means the volume at this point, the volume here on the seller side is too high. We have too less volume on the buyer side, which means the price goes down again. And this is the story of this one candle. Dump money always gets shafted. Of course, yes, but why? I don't really like the word dump money because people are not dump. Of course not. It's bad karma. Don't say that. I would say that's the term in market, of course, I know. But let's say it's a little bit more unexperienced money. And this is the way how I will say it. So this is the fight between experienced money and unexperienced money, which means that we can get more experienced if you are willing to learn trading. That's the point. This means, as a consequence, everybody has the chance to become successful in trading, but only in that way if you're willing to invest in your own education. Okay, so now we have different candlesticks or bar charts. You can see it on the left side, and bar charts and candlestick charts show the same information, but it's just a different way. Candlesticks a little bit more visual to the color coding of the price bars and thicker real bodies, which are better at highlighting the difference between the open and the close. For me as a trader, as a trend trader, I love to see the bar charts because I only want to see here's the bar chart, for example. So I want to see the trend. So, and if I want to see the trend, that's really simple. I just need this information that I can see, okay, where's the correction, and so on and so on. But if you want to have a view or a look closer, then you need candlesticks. This is a private working style, I would say. Okay, we have different patterns. Patterns is again a picture in your mind. So candlesticks are created by up and down movements in the price. So movements, sometimes we have more volume on the buyer side, so we have a move up. And when we have more volume on the seller side, we have a down move. So a price is always in move, always, because we have buyers and sellers. So while these price movements sometimes appear random, at other times they form patterns that traders use for analysis or trading purposes. So there are many candlestick patterns, and we want to focus on two of them, but they are separated into bullish, which means the price wants to go up, and in bearish, which means the price want to go short. So bullish patterns indicate that the price is likely to rise, while bearish patterns indicate that the price is likely to fall. No pattern works all the time. We have no guarantees. And this, guys, this is a real big problem in trading. Because in life, as human beings, we must not work with probabilities. We can work with almost guarantees. Simple example, you want to learn a language, special language. You start to learn the vocabulary, then the grammar, then you build sentences, then you start to talk, and finally, after a couple of time, depending on how much time you spend with this learning, then you can speak this language. That's all. And if you use it almost every day, you will never forget it. Whatever. In this case, you can learn Chinese or whatever, or Russian, whatever, or even German language. It's really not that easy, of course. But I think English learning is not that really easy, by the way. Okay, but if you use it every day, you know after a couple of time, okay, I can talk this language right now. I can speak it right now. And you can rely yourself. You're convinced that you can speak this language. And then with this kind of thinking, you come to trading and you think, okay, this pattern, it works. Maybe this time it works. But then you start to rely and you think it works all the time and it doesn't. And you get confused. And this is why I always talk about the deceptive truth. It's not a guarantee. You have to work with probabilities. That's the point. So one of those patterns are bearish and bullish engulfing. This bearish engulfing pattern develops in an uptrend when sellers outnumber the buyers. And this action is reflected by a long red real body engulfing a small green real body. So this is the right. I can see, I show you this one. So here we go. This one. You see, the red body is engulfing the green one. So it's like a part of it. So and the pattern indicates that sellers are back in control and that the price could continue to decline, which means think about the price and think about the volume, which means the volume on the seller side is higher than the volume on the buyer side. As a consequence, the price must decline. An engulfing pattern on a bullish side of the market takes place when buyers outpace sellers. So this is this one. So you see, this is reflected in the chart by a long green real body, not the spikes, not the wicks, just only the body. Only the body, not the wicks on the other shadows on the upper or lower side, which means that the green body is engulfing the red one, and which means bulls having established some control, the price could hit higher. This means, again, we think in prices and we know the volume on the buyer side must be higher than on the seller side. And this is the reason why we see higher prices. And this is maybe a sign that maybe the correction comes to an end, or maybe the movement comes to an end. And if you are a trend trader, this is an interesting signal to jump into the market when these patterns occur in your correction. This is an interesting idea, but not always. It's not a guarantee, just only probabilities. Okay, let's make a quick conclusion, the bottom line of all this. As Japanese rice traders, emotion, discovered centuries ago, investors' emotions surrounding the trading of an asset have a major impact on the asset movement. So we always talk about the emotions, guys. Candlesticks help traders to gauge the emotions surrounding a stock or other assets, whatever you watch in your chart, helping them make better predictions about where stock might be heated. The message behind it's not an ultimate truth. It's deceptive. It's based on probabilities. So here you can see the conclusion. Candlestick charts are used by traders to determine possible price movements based on past patterns. Possible, not guaranteed. Candlesticks are useful in trading as they show for price points, open, high, low, close, throughout the period of time the trader specifies. And many algorithms are based on the same price information shown in candlestick charts. And trading is often dictated by emotions. I would say not often, I would say always, which Ping can read in candlestick charts. This was a quick introduction into how you can read the candlesticks. I guess it's a general information, but I want to give you this message behind. Don't get confused what you see in the chart. Always think about which one has more volume at the moment. Do they want to go up or do they want to go down? Stop thinking just only in candles. Read the story behind. Try and train to read the story behind. Therefore, I would suppose that you take a teacher for that. It's the quicker or it's a shortcut to your success, by the way. And the deeper message, the real cause. You see, the candle is always the reaction, what you can see with your eyes. But the cause is always hidden in the book map, just only by numbers. And numbers never have emotions, never. Only pictures forces us to have emotions. This is an interesting message for today. If you want to learn more, guys, then you can attend or can join our Trading Spotlight community. And by the way, guys, this is the last webinar for this year, 2020. And I have the great honor to say thank you. Thank you for your time. Thank you the time you spent with me, with Admiral Markets, with Paul, and with Jens. All of us, we say thank you for your time. Thank you for your your lifetime you spent with us. And it was a really interesting year. All of us, we struggled with Corona, of course. But all of us, we had the chance to change the world by a different kind of thinking. How we can do that? Be friendly. Just be nicely to each other. Be more friendly to each other. And then you will plant really good seeds to get more in your life. And I'm really honored to say we planning good things next year for you, to teach you more and more to become successful in trading. We want to start in the middle of January with completely new projects and, how we say, coming soon. And I'm really happy to give you this message. Stay with us, stay with Admiral Markets, stay with the Trading Spotlight community, stay with Paul, Jens, and myself, and we will guide you and we'll lead you next year to success with completely new webinars and ideas. I say thank you guys for spending your time with me. And I want to say Happy New Year. I wish you all the best for the next year, 2021. And I say from the bottom of my heart, thank you for spending your lifetime with me. I hope you were satisfied and I hope you learned something about trading. And I wish you all the best. Most of them health and happiness more than ever before. And we have in our hands to be happy. Be friendly to each other, and it will come back to you with happiness. I wish you a happy new year, and we see each other next year. See you. Bye-bye.